as an entrepreneur, you want to consider how to value your company so that you can get a good return for all the sweat equity that you put into it, into creating the idea, getting things off the ground, and making it profitable. So we're going to talk about how you can value a company in 4 different ways and create a realistic value. So the first one is what we would call a comparable analysis, where you compare your company to other currently successful and operating companies. And the size of each company might be different. So we will calculate their profit and then compare that to the profit to value ratios of similar companies in the same industry. So this is called profit multiples. So we want to calculate the maintainable earnings, that is, the earnings that can be sustained for a consistent period of time. And the acronym EBITDA is often used. Earnings before you take into account interest, taxes, depreciation, and amortization. And then for a, often you'll multiply it by 3 to 4, or sorry, 3, 4, 5, 6. So for many apps, the multiplication factor when they're just starting out will be about 4. And then a larger business, as that has been running for many years and has many branches, is going to have a larger multiple than one that is a single location that has just started out. When there's an entrepreneur and one person is considered the key man, the key person, the key woman who's critical to the success of the company, that actually might lower the multiple, because if that person were to leave, then the company would lose a big advantage. So if there's a very good inventor or visionary and they leave their company, that would be a big loss. So if it's found that the company has a very, very critical person known as a key man, I'm sorry to be a little chauvinistic, but that is the term, but it really could be a key person, a key woman as well, that might lower the multiple. So when we want to calculate EBITDA, we want to find out the earnings, but without any long-term, accounting relating decisions. So for example, in real life, if we were preparing our financial statements, we would consider interest that was paid on loans. However, that doesn't really affect what's happening now. Taking on that loan a few years ago was a long-term decision. So we don't want that to count against a company that is going to be successful just because they got a loan to get things started, compared to someone that might have self-funded. So we don't count those kinds of long-term financial decisions. So it would consider the sales of a company, but not taxes, because that could depend on the jurisdiction, which country it's located in. The tax rate might be different for similar companies located in different countries. The fixed assets, the long-term big purchases like a vehicle, equipment, a building, they lose value over time, and we don't want to consider that depreciation. How a car, intrinsically, a car as you own it loses a little bit of value each year. That's called depreciation. We don't consider that. So again, in summary, how would we do it? Well, we would count the sales, any other income as well, and then subtract the cost of goods sold. So if they're reselling, clothes, they must have paid for those clothes at a certain, or made them themselves. So there's a certain cost of the goods that they're selling, and then there's other expenses, salaries, hourly wages, advertising, utilities, insurance to keep the store running, things like that. But we would not count the taxes that they paid, interest on loan, The depreciation of vehicles and equipment, which again is how expensive things like vehicles, buildings, computers, equipment lose value over time. And also you don't count amortization, which is the idea that if you have a patent or a unique idea, it actually also loses value over time. And so a unique idea, 5 years later is not as valuable. That makes sense, that when inventions are no longer new, they're not as valuable as they used to be. So you only count things related to the day-to-day operations of the business. And if you're looking at their financial statement, you can seek out these figures. Look for the net income, then add what they paid in interest expense, add the taxes that they paid, add their depreciation expense, and add their amortization expense. Or you could look in the financial statements under the statement of operations and find the operating profit, then add the depreciation expense, and then the amortization expense if there is one. Now, startups sometimes try to project 3 to 5 years into the future, so it's important to discount the results back to the present day using inflation so that you get today's value, even if you're projecting 3 to 5 years down the road. So industry multipliers. So sometimes you might be buying a company that's been established. So I mentioned that 3 to 6 would be something typical for a startup that hasn't been proven just yet. Other companies, they've already been existing for a while, and they're valued according to their peers. So for example, utilities might be a multiplier of 8, 9, or 10. Retail could be 10 to 12. Technology, it has very high percentage chance of growth. It can be over 20. Financial services also can be very successful over time, so they can have a multiplier over 20. And so you would look at, what is this? Is this a clothing company? Is this a biotech company? Is this a restaurant? And then you would look at, the multiplier for that industry. And you just would want to consider, is this typical of the industry? Maybe there's some special component of the company that's different, that means that the multiplier might not apply. Will the firm have the same revenue year after year? If the EBITDA this year is unusually high or unusually low, it might not generate an appropriate value. So you'd want to look at what the consistent is, and what's the future outlook. If times are changing, like for example, who knows what's going to happen with entertainment post-COVID, so perhaps a new multiplier would be appropriate to reflect that new outlook. And also, are they dependent on a key person? So in short, company value will equal EBITDA times the industry multiplier. So if we were to take an app that had $25,000 worth of sales, 25,000 times 4 would be about 100,000 would be its value. If we took an established company, let's say it was an established chain of stores, and they had EBITDA of $1 million, we could maybe use a multiplier of 12 and get a value for that chain of stores of $12 million. And that's the industry multiplier, profit multiple method. Another one is cash flow analysis. So we look at how much cash is coming in, and then how much it would cost to achieve a similar cash flow. So a very secure investment would be like a guaranteed investment certificate or a US Treasury bond. You'll never go bust. They're risk-free and they can be cashed at any time. Like an excellent 5-year rate in Canada, if the government bonds were paying great, would be 3%. So, and that'd be risk-free. So keep in mind, when we're investing in a business, it might, would have a chance. There's some chance of failure. So we can't really expect, a risk-free rate of return. So, for example, if we're doing the company value, and the company took in $50,000 worth of cash in the last year. Well, in a risk-free situation, 50,000 divided by 0.03, would mean that that's the equivalent of investing, $1.6 million in a risk-free asset. So, however, this company is not risk-free, so it's going to be worth 1.6 or less, probably quite a bit less. You just, have to figure out the chance of the company going bankrupt. So that would be, for an example, if we were, here's an example. So, in 2019, Air Transat was an airline, and so Air Canada was considering to purchase it. So at the time, Air Transat, you can see at the bottom there, is making 26.7 million on its first quarter. So that would be, I guess, times 4, 104 million. So it's that means that if the valuation is 488 million, Air Canada is hoping to get a return of 21%. If I take that 104 divided by 488, that would give me a 21%. So, that's more realistic. I mentioned, hey, that a risk-free situation, you might be getting 3 to 5% per year, but real life is not risk-free. So businesses are going to, expect a higher rate of return. And for example, the venture capitalists on, Dragon's Den, they would be requiring about 25 to 30% rate of return due to the high risk of so if someone came on Dragon's Den and they told them, okay, in the last year I made $75,000 in cash, that was my cash flow, well, the Dragons would, value that at about $250,000, because 75,000 divided by 0.3 would be $250,000. So that's, that you got to consider. Bigger companies, bigger investors have a little more negotiating power, so that's why the rate of return is so high. And then things to also consider: what's the failure rate of a business? Some businesses, like restaurants, have a pretty high rate of failure. And then also, well, okay, what if the business had a bad year for short-term reasons? Something, a black swan event occurred. Otherwise it's normally a very profitable business. Well, then this might not be the best reason, because it could have undervalued the business. So again, look at the cash flow over a long period of time to get an idea of whether it's consistent or just a bad year. So we could also look at precedent transactions, comparing the company to previous sales that we've seen. So in 2018, Cara, the restaurant chain, paid $200 million for the kegs, 106 locations. So what would a comparable price be for Jack Astor's, which has 56 locations? Well, we don't want to say, are they the same size as the keg? Is Jack Astor's as profitable as the keg? Does the keg have a little bit of a better brand name? And so maybe we might come to the decision that, let's see, 46 divided by 106, is about 43. So maybe since Jack Astor's has 43% as many locations as the keg, Cara's starting price for the negotiations, they might make an opening offer of $86 million. That's about 43% of $200 million. So since Jack Astor's is 43% of the size of the keg, Cara might start the negotiations with a offer of $86 million. And then, is the value out of date? So right now, that transaction, is in 2018. It's still recently reasonable. But sometimes the only precedent transaction is from many years ago, and it's no longer appropriate to consider it. And then again, every transaction's different. The keg is different from Jack Astor's, so using the same methodology might not be the best idea. And then lastly would be the cost approach. This is not commonly used in Canada, but it is an approach. So what would be the cost to rebuild the business? So if we were to start from scratch, how much money would it cost us to put into the business to recreate it? Or roughly what has already been spent? But it's not widely used. It sounds like it would make sense. Like, yeah, I put $2 million into this business. It's worth $2 million. Well, that might not really be the case, because money that's spent is what we call a sunk cost. It's not coming back. So we don't want to just use it in our decision making. Like the $2 million, maybe it was, it shouldn't have been spent that way. Maybe the prices weren't right. We couldn't recuperate it if we tried to sell everything in the business. So it's a sunk cost. You got to forget about it. That's actually a good lesson for life too. If you spend money and it's gone, don't spend more money chasing it. Like, for example, if you made a bad investment, don't hold on to it hoping you'll get your money back. If the time is right to let it go, just let it go. That money that you've lost is a sunk cost. It's gone. Or if you've put money into a home to kind of make it nicer, don't think, oh, I've spent all this money on the house. That's in the past. That has nothing to do with whether you decide to sell it or demolish it and build a new one. Now, the liquidation value is the value of selling all the fixed assets. So if we took all the vehicles, all the equipment, all the computers, the tables in a restaurant, all the physical fixed assets, and sold it, well, that's probably much lower than what was actually paid for them, because these are all now used pieces of equipment. Say we were selling a restaurant. Well, no one's going to want to pay as much money for secondhand tables. They'll offer you much less. It might be easy to sell the restaurant kitchen equipment because there's always new restaurants starting that need kitchen equipment. But say we had an automotive shop that was making custom engines. Well, some of that specialty equipment might not be in demand, so it could take a few months or even a year to find a seller for it. So sometimes the liquidation value, what would it be if we sold everything that the business owned right now? That's often much lower than what the actual cost that was paid for them. So those are our factors for making a decision. Industry multipliers is very comparable. Precedent transactions is also comparable, but the cash flow analysis and the cost approach